Imagine earning money while you sleep, travel, or simply live your life. That's the magic of dividends. When you own shares of a company, you can get paid just for being an owner. No selling, no market timing, just holding and collecting profits. This payment is called a dividend, a portion of a company's profits shared with shareholders. Many big familiar companies, like Apple, Walmart, and ExxonMobil, pay dividends regularly, rewarding investors for their loyalty. Dividends are typically paid every quarter, and the process is automatic. Own the stock before the ex-dividend date, and the cash lands in your account on payment day. You don't need to fill out forms or make calls. The money just appears, ready to use or reinvest. It's a simple, powerful way to build wealth over time. Anyone can benefit from dividends, not just Wall Street pros. By owning shares in strong, stable companies, you can turn your investments into a personal money-making machine. That's the power we're unlocking today. Let's see how dividends compare to other forms of passive income. Dividends might sound like the interest you earn from a savings account, but there are key differences. Interest from a bank is guaranteed, and your principal is protected, safe, but with limited growth. Dividends aren't guaranteed. Companies can raise, lower, or stop them depending on their financial health. But with dividend stocks, you have two ways to win: regular cash payments and the potential for your shares to grow in value. A savings account is like a safe harbor, steady, predictable, and essential for emergencies. Dividend stocks are more like fruit trees. They can provide regular harvests and grow bigger over time, though there's more risk. The combination of income and growth is what makes dividend investing so attractive for building long-term wealth. Understanding this distinction helps you balance safety and opportunity in your financial plan. Both have their place, but dividends offer a unique path to wealth. Now let's explore why some companies pay dividends and others don't. Why do some companies pay dividends while others don't? It's all about their stage of growth and strategy. Mature companies, think Coca-Cola or Procter & Gamble, often pay dividends because they generate more cash than they need to grow. Paying dividends signals financial strength and attracts investors seeking steady income. On the flip side, younger, fast-growing companies, like many tech startups, reinvest profits to fuel expansion instead of paying dividends. For them, every dollar goes back into research, development, and growth. Not paying dividends isn't a weakness. It's a strategic choice to maximize long-term value. Investors in these companies are betting on big stock price gains, not immediate income. Whether a company pays dividends or not depends on its goals and where it is in its journey. Next, let's see how dividends and patience can transform your financial future. Meet Clara, a school teacher who started investing small amounts in dividend-paying stocks. She chose companies she knew and used a dividend reinvestment plan, DRIP, to automatically buy more shares with every dividend. At first, her dividends bought just fractions of shares, but over time, those fractions grew. Each new share earned more dividends, which bought even more shares, a snowball effect. Decades later, Clara's portfolio generated thousands in quarterly income, all from her steady, patient approach. She never had to sell her shares. The dividends alone funded her retirement. Clara's story proves you don't need to be a financial expert, just consistent, patient, and willing to let compounding work its magic. Start small, reinvest, and let time do the heavy lifting. The earlier you start, the more powerful the results. Now, let's talk about how you can begin your own dividend journey. Here's how to take your first steps. Ready to start? Begin by learning the basics. Understand terms like dividend yield and payout ratio. Open a brokerage account with low fees and make sure it offers automatic dividend reinvestment, DRIP. As a beginner, consider starting with a dividend-focused ETF or mutual fund for instant diversification and lower risk. Look for funds with low expenses and a history of consistent payouts. Start with an amount you're comfortable with, even $50 or $100 a month. Set up automatic transfers to make investing a habit. Be patient. Dividend investing is a marathon, not a sprint. Let your dividends reinvest and compound over time. With consistency and time, you'll build a powerful stream of passive income. You can do this. Your journey to financial freedom starts now.